You're live now.
What do you got, Berna? Anything?
What do I got?
Good.
Well,
Did you guys see? I'll start with something. Did you guys see?
I'm like a broken record. I'm buying Five Below, Dave and Buster's, and that's I'm like I'm like a broken record on the same. I'm slow money.
Got it. Paul Tudor Jones did a very comprehensive interview on CNBC this morning, and for you gold bulls, he pitched. He said all roads lead to inflation, and he's long crypto and long gold. He owns no long or intermediate term duration fixed income at all, and he intends to go short the long bond at some point when the market has the aha moment with the debt value. So I tend to call that the billionaire's lament. You make $1 billion, and then you see everything wrong in the world, so you become obsessed with it because you made enough money. And you tell people stocks are overvalued all the way, which, they're very richly valued. But a lot of the billionaires are, these doomsayers these days. They'll be right. They'll be right one day. Japan is way ahead of this stuff.
And they all have a bunker in New Zealand as well to go with their bearish position.
I don't know how to be a bunker. I got a lot of glass in my house. I got a lot of guns and ammo, but that's it.
There we go.
I had a guy try to give me a couple extra boxes. I said, look, I got 10,000 rounds. If I need another round after that, I'm in trouble.
Okay, I know whose house I'm not breaking into.
Marcin, what state do you live in?
Pennsylvania, the key swing state.
Suburb of Philadelphia. So
You should sign up for that $1 million that Elon was giving away.
Yeah, I live I'm divorced. I live by myself in a 10,000 square foot house. It's kind of stupid, but
I've seen the house. It's very nice.
I'm too lazy to move. Ben's going to visit one day. Ben's going to come out.
Yeah, I'm going to come out there. We're going to hang in Philly. I haven't been to Philly in so long. I'm overdue.
Yeah.
Philly's a good town.
I love Philly. Philly's awesome.
Are you a Max or Geno's? Pats or Geno's? Max, whatever.
Yeah, I'm a Geno's versus Pat, yes. But the best, and I haven't had Angelo's, which the Barstool Sports guy, the Barstool Pizza guy, says is the best in Philly. He says they actually have the best cheesesteak and the best pizza. So that's where you want to go. If you ever visit Philly, you want the best pizza and the best cheesesteak. It's in South Philly. It's called Angelo's. I was there once at 11:30. It opens at noon. There was a 50-person line waiting to get into the door at 11:45. Crazy.
That's dedication.
That is.
So, Ben, you had Joby on your podcast, obviously.
We had the director of engineering on the podcast. He was also the 12th employee at Tesla and was the director of engineering at Tesla in the first 7-8 years.
Yeah, there's so much skepticism around these e-balls, but they're only going to keep getting better and safer. I mean, it's super interesting. And everyone's this is the leading company here, right?
What?
I said this is the leading company, and
definitely. The Archer has a couple issues. I can talk to that a little bit. The Archer's backed by Stellantis, and I think everyone knows their situation. So the cash flows there are a little bit at risk. And then they just demoted their engineering guys. So I think it's run by some financial-oriented guys, which in this situation, you want engineering-focused culture in the early days of these things. But these guys have been around since 2011. It's not like it just started a couple years ago.
No, these things take a long time to get going.
Is that public, Ben? That stock?
Yeah, Joby.
Oh, I didn't realize that. I thought you meant that was a private equity deal. So
No, I'm just saying it's a VC style investment. It's a public.
Yes.
It can't.
Okay, well, we're
it
gonna
can't.
get into it. We're gonna get into it right now.
right.
Let's start the show. So, hello and welcome to the Beats Roundtable. I am Berna Barchet, and today is Tuesday, October 22nd, and I am here with the group to talk the markets and their best investment ideas. With us today, we have Ben Bry with a VC-like public stock investment. It does trade. We're going to talk about it in a minute. Our tech guru, Russell Young, I'm sure will have thoughts on that. And value hunter Robert Marson is here with an update on his favorite semi. So, Ben, tell us about this stock that you're excited about.
Morning, Burnham. Morning, guys. So last week we had on the director of propulsion engineering from Joby Aviation, a guy named Dave Lyons, who happened to also be the head of engineering at Tesla in the early days. He was the 12th employee at Tesla. And it was a fascinating conversation in our pod, Just Think About It. And I encourage you to go listen to it. The basic premise was Joby is the leading player in electric vertical takeoff and landing vehicles. So think drones for people. And the idea is initially to replace helicopters or take market share from helicopters. So the idea would be you go on an app, they pick you up at your house, they take you to a local takeoff spot, and then they have a 25-minute flight to the airport and drop you off on the delivery side right at the Delta terminal. They did a deal with Delta, for example. There's a bit of a land grab to this where they have mapped out or done the land grab to LA, New York, right off the chute. And the number one competitor, Archer, who I think they have a major advantage on, is in Chicago. So I do like that concept of the business. It's early days, but hey, the first mover will have that land grab advantage. So obviously, I'm much more of a value-oriented investor, but the way I thought that this was interesting is that it's a kind of thing where there's a lot of skepticism, there's a lot of lazy shorts in it, and there's a huge engineering culture there of really smart people who, Dave expressed to us, he's like, it feels just like it did early days at Tesla. And there was a lot of skepticism at Tesla for a long time until it turned into $1 trillion company, right? And so the market opportunity here is such that initially it will be local flights, kind of helicopter. And the reason you could say, okay, well, we have helicopters, why these? First of all, these are quiet. Second of all, these have better tow capacity. So third, and most importantly, probably, is that they're safer than helicopters. And so there's a clear shot to take market share there. Then the second, that if they can get that into commercial by the end of the decade, you're looking at right now it's a $4 billion market cap company, $3 billion EV, burning about $300 to $500 million in cash a year. So at minimum, probably needs $3 billion of capital. So that would be the one trick. You have to say, okay, can they protect the equity while getting the capital in the door? That's the major, question on the stock. But then, you think that can probably be a $20 to $25 billion company on just the flying taxis, if you will. The second iteration, which they're already working on, they just finished a prototype for regional. So think LA to San Francisco. LA to San Francisco is probably gets it to a $50 to $75 billion, market cap. And then they just did an acquisition of this X-Wing autonomy. And I think that's where you got the holy grail of you could have people like they do for the military driving with joysticks in some warehouse and flying people around, picking you up, dropping you off. And then you're at $100 to $200 billion. And so at $3 billion EV, $4 billion market cap, without what are the numbers, you're basically saying, hey, this is a convex bet that could have a very large payoff, and you're essentially betting on the engineer culture, it's how smart these people are, and that they're going to improve prototypes as they go on. They have a capital advantage over their competitors, and they have a technological advantage over their competitors. So I think there's a large market opportunity. And I think, in essence, you want to watch the market, the people at the company. I had a bull on the street reach out to me after our podcast and kind of talk to me through their thesis, which was written up on Value Investor, by the way. It It was a good write up. And they say, hey, if they start to see turnover of management and they see people leaving, that would be the sign, hey, things aren't good. So as long as the team stays together, you kind of think the thesis is going to be together.
Mm-hmm. How long do you think it is till they have something that they can commercialize, that they'll actually have like a product with revenue?
I mean, I'm looking at the Morgan Stanley model right now, and I think that they've been a little bit coy on giving as much details as the street would like. They're waiting for an FAA transition approval, but I think it should be in the next 2 years, I would guess, and then the ramp goes into. Like Morgan Stanley has them at $3.5 billion of revenue in 2030, $5 billion in 21 or 31. It's kind of weird to say 31. Now I'm sounding like Russell talking about 2031. And but I think that this is a little early for the leaning on the exact curve. I think you're thinking more like what's the 10-year opportunity, and then are they making progress? Are they keeping the team together? Are they getting the funding? There's a DOE loan that should come. It's about another $1.2 billion within a year. And also one thing I didn't note, they have contracts with the government already, like all good aerospace companies do. So there's rescue and release or a recovery option. The military is obviously big into drones. And then you have the commercial aviation airline, if you will, aspect of the business. But I wouldn't think of this as like a manufacturer. This is a carrier.
Mm-hmm. Why do you think this public? How long has this company been public?
Right. So, okay, this is a good question. They came public
why
in the SPAC boom. They came public in the SPAC boom of 21. So them and Archer, when everybody was getting a SPAC, they came public. And like many of those companies that were promising interesting companies, they had no business being public that early. It was just that everyone could get a SPAC, and SPACs were getting funded. And so, it's one of those things where they're out way too early. Now they have promote that can be erased. So I think that if you had the promote structure they have here, there would have been a lot less SPACs. So you have like a decaying promote on this, but struck much higher. So it's like a 550 stock, and you're well over 100% before you have any of that promote come in. And then again, the one thing you would say is things not going as fast. Yeah, sure, you lose a little bit, but you also decay that promote as well. So that's a little bit of an offset to the initial decay that you would just have as a normal equity holder if it wasn't a SPAC, with a bunch of options outstanding.
So Ben, I get. How does this promote? The promote works like they're getting a preferred return, basically, but
no, it's like warrants, like any SPAC.
A warrant. Sorry, okay, so they get additional stock struck higher, but it erodes with they basically expire. These call options expire over time.
Warrants expire correctly. Correct. Yeah. Yes, exactly. So usually it's 5-year warrants. So if you're struck in 2021, you have 2 more years on those. But the one thing I'd say is investing in technology companies, you often have a stock option component to it, right? Like those engineers, all the smart people, that's the way they're compensated. They're underpaid in cash, and then, they're overpaid in call options for the successful scenario, which, honestly, as a hedge fund guy, I think everyone's, understands that. It's like, yeah, sure, you gave up some of the promote, but you're happy if someone can make you 24% net a year. You don't care. You know what I mean? You're like, hey, you get paid, I get paid, type of thing.
Mm-hmm.
Ben, what's the current flight time, and where does it really take off in terms of duration in the air?
So the local business is about 25 minutes with like 30 to 35 flights a day is kind of like the consensus model. Again, they haven't been overly detailed on the unit economics yet, and I think that's one of the things a lot of the guys in the street, pod shop guys like to put hard numbers and ping management to it. So they haven't done that as much, and so that's one knock if you were like, hey, I want to know how many flights a day, but I think you can interpolate it by how much time. Now the one question I asked Dave was like, where are you going to get the pilots? They've already worked on that. But again, that could be just a short-term issue if they get the autonomous right. And then in 10 years, 8 years, I don't know exactly. Tech curves can move faster than you think. Then that might not even be an issue. And that's a huge cost savings as well.
And don't they have an agreement with the commercial airlines so they can do jumps from like Newark to LaGuardia and stuff like that?
Yeah, they did an initial deal with Delta. But I think it'll be partnerships and land grabs. And that's another reason why I think just from like a normal business model, it's like real estate land grab. You're like, okay, I mapped out this airport. And now they got LAX, they got New York. Like being there and getting that traffic, being close to that traffic, they need to be in city or areas that are dense, right? Like this could work for the military, for a rich guy in Montana, but for a business, you're thinking it's got to be closer to how an airline works. There's going to be flow, and there's going to be enough that you have enough flow on a daily basis. And my thinking on demand is such that you're not going to have any issues on the demand side until there's about 800 to 1,200 units in the air, and they're not even close to there. So on the demand side, I think you got a long ways until you're like, how many people will take these? How long will it take for people to get comfortable to go in them? And I can tell you, as someone who's been in helicopters a lot, I'm very nervous every time I go in a helicopter. It always feels wildly dicey. So these have 6 propellers and are, I'm taking a lean on Dave. He's telling me they're much safer than a traditional helicopter.
Where would they pick the passenger up? Where would they pick me up? In my backyard, on the street? Do I have to go to a small airport?
So they have jump off. The plan is to have jump off places all over the place, and basically, you will go on an app like Uber, and then they'll come pick you up in a car, and then they'll just take you to the jump off spot, and then it'll take you right to the Delta terminal, and you won't have to like go through the traditional TSA line and skip the bags line. And I've done that before on a helicopter. You have a separate entrance if you go take a helicopter flight in or out. So it'll be similar to that, where you have a relationship with the airport, relationship with the airlines, and so you'll pay a premium price for that. But the thing about it in LA, if you were like living somewhere like a Malibu and you needed to get to LAX and it's an hour and a half, 2 hours, and you value your time, you're going to do that. And if you can do it in a safe way, there's just enough money where people value their time higher than what the price is, that they'll do it. One thing that the person mentioned to me is that the competitor Archer does have some issues. And so some people are playing this as a pair trade of long Joby and short Archer. I don't know enough about that to like have an interest in that. I like this, just to bow tie this, is like, I like convexity. I like things where I can make multiples of my money. And this seems like it's something that down the road makes sense. And if there's a smart culture of people working on a big problem or a big opportunity, you can put a small position in, forget it. Then maybe one day you wake up and it's worth 15 or 20 times more than when you put your money in, and then you pay attention to emerging technology. But you have to find risk and multiples of your money on the upside. That's the way I'm thinking about it. Basically
a perpetual call option.
Yeah, well, just like a leap, if you will. You know what I mean? Yeah, like there's some decay. There's some decay that, like, let's say if they burn $300-400 billion of cash a year, and there's $4 billion of market cap, call that 10% decay every year, in essence.
And so this 17% short interest, do you think that that's purely about the burn rate and the risk that they run out of money, or is there a short story out there about the technology not working?
I think that, well, again, to defer, the person I talked to said there's a lot of lazy shorts in there, which I know, because I've been a lazy short before, names where it's like, oh, they're going to run out of money. Oh, electric vehicles, whatever. It's like easy for humans to like be dismiss new technologies that are capital intense. But like the government seems to be interested in these guys. Toyota just gave them another huge check. Toyota's like, they're working with Toyota. One thing I would tell you that was a really interesting tidbit that is more bullish, they're going to open up a manufacturing plant in Dayton, Ohio. And Toyota's helping fund that. But not only are they helping fund that, they're putting 200 Toyota engineers on site to get them really up to scale. And this guy Dave told me that if they would have had that in the early days of Tesla, he's like, we never would have had the production delays. He's like, that I can't tell you as an engineer how helpful that is to have like that quality. Toyota, like they're gonna like help the ramp phase of manufacturing these planes. So it seems like they have the right partnerships and the right people and a real opportunity. And if there's a true improvement, versus regional flights versus local helicopter flights, that there's a interesting market opportunity. And so, it's not my normal thing to be talking about VC style investments, but it does seem interesting, and I like the payoff structure.
Well, it's definitely one to watch. Ben, thanks for introducing us to that. Did a little bit of a deep dive here because interesting company, not one I heard of before. Russell, what do you have for us for today?
Yeah. Hey, good morning, Berna. All eyes will be on Enphase reporting tonight. I've been negative on Enphase, and I continue to be. There's been some recovery, and Enphase makes inverters for solar panel systems on residential homes. And they were seen as the leading technology by having microinverters, which for a while simplified installation and allowed you to see what was happening in every panel. But what's happened now is the rebate structure in California has changed to favor batteries. And Enphase's solution now is expensive. And Tesla's come in and has disrupted this market. My checks show that batteries are front and center, the topical point, and Tesla has the best battery system. It uses string inverters that can totally skip out Enphase's technology. And so I think, my guess is they probably hit the quarter, hit this number, but then give soft guidance, or we'll see something with margins. So it's like something's going to go wrong with the numbers. So that's how I'm watching tonight. So I'm still negative and very concerned about the outlook for Enphase. Just Tesla Powerwall is ramping. Dealers are having product. The more people install it, the more they love it. It's easy to install. It's a lower price at a time of high electricity prices, where consumers and installers, they need a lower price solution. So I'm negative there. And since we're talking about energy, there's all this excitement around nuclear power, and all these stocks are going bonkers. But right now, I think it's time to be selective about what you're looking at. Now, in a bull market, the junkiest companies go up the most. And we've seen a lot of companies with questionable, very long-dated technology and nuclear energy go ballistic. You look at the small modular reactor stocks, NuScale, symbol SMR, and Oklo, symbol OKLO. There are 56 companies out there doing small modular reactors right now. And the checks on these two companies are actually fairly negative. That you look at what Amazon and what Google have picked for their small modular reactors, and it's not these two companies. So this reminds me a lot of the LiDAR sensor market when everyone came out with the technology, and there's so much competition that by the time the market sorts out, that most of these companies will fail. So I would avoid those stocks. Also, Centrus Energy, the stock has it's gone up dramatically as a play on we're going to need a new form of highly enriched uranium. Well, when you look at this company right now, what they do is they import Russian product. And there's a ban right now trying to prevent us from importing Russia uranium. The company says, pay no attention to that. The future is about, creating highly enriched uranium in this country. But they really don't have much capacity at all to do this, and they're going to have to build this all out. The stock's up a ton on some DOE grants to get into this business, but this is very long dated. This isn't going to happen for 3 to 5, maybe 10 years. But more importantly, the government gave awards to 4 companies. So Centrus is one of 4 winners, but one of the other people who won is getting an award from the government is General Matter, which is a Peter Thiel-backed company, which people are speculating they're using a laser technology to enrich uranium that could totally disrupt the cost curve. This company is in stealth mode, but we could seeing material changes in the costs of enriching uranium. Every other uranium Enricher out there is a state-backed company. This has not been a private industry business. The last time Centrus tried to do this, they went bankrupt. So there's just a ton of uncertainty. The stock's up a ton on this, and I would just be skeptical and be careful of the stock here. Symbol LEU.
Yeah, that makes a lot of sense.
Russell,
I did want to ask you.
I got a question for Russell. You killed
Sure.
it with the SolarEdge shorts. Congratulations. Phenomenal trade. Are you still short that stock down at 16 or 17?
Oh, no, that's for SolarEdge. You know, I'm neutral on SolarEdge right now. I think they have huge problems, but we're getting close to kind of balance sheet. And it's just super hated. So I'm just kind of watching it now. I wouldn't, you know, I'm not short, I'm not long, I'm just kind of hanging out.
Are you thinking about buying it as a turnaround? Because I bought this at 13 and sold it at 65 to 200, and I've been waiting to get back in ever since. But the numbers and the business model has been so atrocious. So if you cross this off, have you gone to? I wouldn't buy this at any price mode with this stock because of the business.
I think right now the European solar market is so flooded with product and inventory, and they're just burning cash, and they have like their inventory is out of control. It's over 3 years worth of inventory. So the numbers are still really messy, and so I think we have to see some signs that that the balance sheet is going to clean up or that Europe's going to stabilize. So right now I'm just watching. I hate buying these things when they're in a kind of a tailspin and they're saying it's going to be great, but I'm more along your signs, right? Of let's see where there's a sign that they can stabilize it, because it is kind of sitting, you know, at balance sheet support levels.
Right.
So it's a good question.
I'm going to move on to Robert. You're going to catch us up on a semi-name that you've talked about before here.
Yes, Silicon Motion. It's a Taiwanese headquartered, NASDAQ only listed company that makes ASICs for controlling NAND flash, as well as in memory form and in storage form in SSDs. So the company, it's been a solid grower. I mean, I think 10 years ago they did 250 million in sales. They hit almost $1 billion 2 years ago at the top of the sort of the panic buying of phones and PCs and laptops for COVID. The sales dropped down to 700 million for a run rate basis, and now they're recovering to 800 plus million this year, and the forecast for next year is 900 million. So the controller, a NAND flash device is a dumb receptacle of information, and the controller is a mixed signal chip which means it's not made in the same process. So it's not that they could run these in the factories where they make the NAND, where the NAND makers make the chip. So there's an independent market, independent manufacturers of controllers. It used to be a very simple technology, but as the NAND keeps getting more multi layers and quad cell versus one. Usually it was 1 bit per cell, then it went to 2, 3, and now it's 4. So there's QLC, they call it, NAND, that's used in these devices that they have to manage. So it's become a much more sophisticated IP set of firmware that you need to run this. So they have a moat, and they're very good at it. So I think the investment thesis here is you have to buy what Apple shareholders are buying, right? Apple shareholders are paying 30-something times earnings for no revenue growth for the sake of some major, epic replacement cycle as Apple adds AI capability to the phones, correct? That's what they say. And it's pitched out there on Wall Street every week by the sell side. So if I don't necessarily know if we're all going to buy new computers, laptops, notebooks, and cell phones because AI becomes a consumer product. But if it does, there's a very large product upgrade cycle because these devices will need more memory, more storage, and much faster throughputs for how it works on our devices. So if there is this big upgrade cycle, These guys, they operate in a traditional semiconductor model. They introduced a new product at a higher price level, and then over time the prices come down. So when they have a new product cycle, they for the first year or two, they make a lot of money, and then as the technology price drops, they've got to replace that with something new and better. They did say that right now their next generation product for cell phones will be twice the capacity at the same electricity consumption level versus last generation. So they really are trying, they really are improving their product. So the stock is down, it's cheap. There was a little frustration on the last quarter where they identified their big growth play, which is data centers and enterprise. 75% of the market for controllers is data centers and enterprise servers, and they don't compete there yet. They have their first product, and it's going to be produced in the fourth quarter of this year, which is now, and it's going to ramp next year and then become a much bigger deal in 26 and 27. So they said people think that should be by far the biggest product line for them down the road, but they said it would only be 5 to 10% of revenues in 2026 or 2027. So that sort of bummed people out, and there's never been a turn in the PC business or the cell phone business that's been real. So the numbers came down. The stock hit 85 earlier this year, down into the 55, 56. I'm buying it the second time down here and making it. I went from a starter position to a small position, but I think they can make the streets 450 next year, 350 this year. So I think there's a good chance they can make $5. If they make $5,
yeah. What is their end market? Is it mostly PCs and cell phones right now, or what are their end markets?
Yeah, it's only PCs. They have a huge share of PCs and about 30% market share in PCs and cell phones. Yes, that's their big market. And then they have IoT. They sell a lot of 30-cent controllers into toasters and microwaves and refrigerators that happen to have storage in them, memory or storage. So they have a big business there. So yeah, it's gaming devices. It's a lot of they're really in a lot of consumer products. And as you know, Russell, that's not a great place to be, right? So they do well in that business. So here's what they said about their data center business. Their product was a white sheet design 3-4 years ago. It's very hard to get into this business. They compete with Marvell, which really owns the business, and they compete with the NAND makers themselves. So Samsung makes the NAND. Samsung wants to make its own controller, and if Samsung chooses to go that way, these guys don't have a chance to bid on that business. So there's been a move towards outsourcing, especially the lower end products. So these guys keep picking up share from Western Digital or Samsung or Hynix or those kinds of businesses. If they crack the data center business, which again, they have two customers, they have two large customers now, hyperscalers. They have two more hyperscalers being booked this quarter, okay, for shipments next year. So if that business takes off, I think they're sandbagging on the $50 to $100 million in revenue from that product by 2027. I would hope that that's 26, and 27 is a lot bigger than that. But these guys should grow. It's a $25 billion market growing double digits. The controller business globally. So they have $1 billion of share in $5 billion TAM because they don't participate in the best part of the market, the other 15 or $20 billion of TAM for data centers and enterprises. But that product they have has gotten phenomenal reviews, and it's just a matter of time. Now, here's one other thing that these guys are not getting credit for with Wall Street. They have a business model, 50% gross margins and 20 to 25% operating, 20% operating margin. So their OpEx is like SG&A and R&D at 30%. So to 25 to 30%. So 20 to 25% operating margin. So these guys are spending 26% of revenue today on R&D. They normally spend 18 to 20. That is 600 to 800 basis points of net margin expansion when they normalize. And the reason they're doing that is because 2 years ago they were selling product, Russell, on 28 nanometer, and their new generation is now designed on 6. So a tape out costs $20 million. They have 6 tape outs. It's crazy. They have so much opportunity for so many new designs through RFPs that they've really, overshot how aggressively they're spending on R&D. And they said over the next 2 years, as the revenues from these new products, which again are higher priced than the last generation and higher performance, as the revenues kick in, they're going to keep the R&D flat or actually let R&D fade as an absolute number. So there's no reason these guys should not have significant margin expansion with modest revenue growth and 50% gross margins. They're in the 47% now. So you have 10 percentage points, 1,000 basis points of potential margin expansion when you normalize R&D and get them back to their gross margin level that they target.
How long till that R&D you think starts to normalize, Robert?
They've said this year's the peak, so by two quarters, I would hope, they start
to. We should start seeing that operating margin improvement next year. Is what you're saying?
Yeah, and that's how you get 350 to 450, right? Because they're only, the forecast is for 820 million to 900 million next year in sales, right? I would think they got a shot of doing a little bit better than that, and then the following year, well over $1 billion. So if you do the numbers, you're making they've had quarters where they made $1.50 to $2 in the last cycle, a quarter for 2 or 3 quarters. I mean, they had an $8 estimate out there when they did $6 in the last cycle, the peak for the out year. So you have a 56 and change dollar stock today with $10 in net cash, no debt, and a possibility of making $6 in 2 years. So I'd say $5.50 to $6 if the margin expansion really hits. And if that data center controller takes off and they really get share, that's the aha moment where the company gets a 20 PE on a $5 or $6 earnings number.
Yeah. So that's how you get to over $100 stock here.
How you get back to 100?
I'd love to hear more about. Yeah. Because the flash is taking up the data center. Spinning disks take up like 20% of data center power, and everyone's paying a huge premium to take down, to optimize power in data centers. It's super hard. So if they are getting a big win there, that'd make it super interesting for sure.
Yeah, these guys.
Okay. I think Ben's got something, and then we gotta move on. So Ben, what do you got? You're muted.
No wonder why no one was letting me jump in. I was like, what's going on here? Should put myself on mute more often. All right, so this is actually interesting. So these guys make about $90 million free cash flow, like a 5% free cash flow, a little bit of market share gain in the slow, boring areas, and then they have like an embedded call option in the data center, and they have overinvested, or maybe not overinvested, but they have this embedded investment cycle that they come out and they get the margin expansion. So is that like a fair way to put it, boil it down?
Absolutely. The boring PC and cell phone business, they're taking share. They have the best products in the world, according to independent surveys. And, they'll do fine without the data center, really taking off. But if the data center takes off, it's a completely different, 15, 20% revenue growth story with huge ASP increases and large margin increases. Yes.
Where do you think the multiple would go?
Why not 20 for a global leading semiconductor company? I'd say 25 if it were U.S. based, but headquartered in Taiwan, I'd give it a 20.
All right, so you could have like $110, $120.
I don't think it trades on the Taiwan Stock Exchange. They delisted there in 2005, and I don't think they've ever reapplied. But I have to look at that. Ben, you can look at that for me. Russell, you're
Anyway, this is so the primary listing is the SIMO on in the U.S. That's the primary trading here.
Yes.
Well, it's an interesting idea, Robert. I'm definitely going to check in on their earnings next week and start doing a little work here. Very interesting. I want to make a programming note that tomorrow we'll have a guest. Darius Dale from 42 Macro is joining us. So we're looking forward to that. If you want more details on any of the ideas that you heard about today, check us out at wallstreetbeats.com. So thanks for joining us today at the Beats Roundtable. I'm Berna Barchet, and we will be back tomorrow.